Assalamualaikum warahmatullahi wabarakatuh. I am Dr. Adli. I would like to continue on the chapter 17 on financing. So basically, in this part, this video part, we will talk about Islamic financing. So this is actually an extract from the book Introduction. We call it Muamalat Introduction to Akli and Akli, the integration of Akli and Akli. So basically, for the Islamic financing, so we know that in terms of financing, we can get from debt financing or from equity financing, as I mentioned in the previous video. So and also there will be financing that we can gain from the suppliers. Okay, we can get pre-financing if we get credit terms from them, and part of that, there are two type of what I call it. What call it finance, whereby we want to go for the conventional finance, which is based on the interest or riba, or we want to base on the Islamic financing. So in this video, I will actually explain a little bit on the Islamic financing, but probably will you have to actually do some more what I call it readings in terms of the Islamic financing, because we do have a lot of new products or new innovation that is coming out from the Islamic banking and Islamic finance in terms of this product. Okay, so here if we look at the Islamic finance product, so basically we can actually divide it into four. The first one is sale-based financing. The sale-based financing is actually considers of different type of contracts. So the three contracts that I've given in my text is actually murabaha, the buy bithaman ajil, and also the buy al-ina. And also the next one is the lease base of financing, which is the operating lease or the ITAB. Okay, ITAB is actually whereby you actually lease and then you buy back. And then for the project financing is we will look at musyarakah, the contract of musyarakah, which is partnership, and also the contract of mudarabah, which is also the contract of partnership, but in terms of the between the capital contributor and capital provider, and also the entrepreneur. And then we also have the trade financing. The trade financing, here we have the letter of credit. The letter of credit, we can have the wakalah letter of credit, murabahah letter of credit, and also musyarakah letter of credit. All right. Um, let's look at the first one, which is based on the sale-based financing. Let's look at the murabaha and also the buy bithama ajil. Okay, basically for murabaha and buy bithama ajil, okay, in the text we have actually provide you, okay, a diagram on how actually the murabaha and BBA can be actually done. Okay, so we have this financial, we have the owner of asset, and also we have the customer. First, the owner of the asset has to sell the asset to the financer. So in return, the financer will pay the purchase price to the owner of asset. So this is the second what call it procedure here. And then the asset will be sold to the customer, okay, at a certain price, and that price is actually consists of the purchase price, which is this, plus profit. So this is the what you call it, the markup base. Okay, murabaha is actually markup. So the financer will mark up a certain percentage of the purchase price plus the profit to the customer. So and some of the scholars also call this as a markup cost product. And for BBAs actually it's the same as this murabaha, but okay, for BBA you will be actually what call it, the customer will be paying, okay, the purchase price plus profit in installment basis. So the difference between the two contracts is the customer need to pay the lump sum amount to the financial for murabaha. So murabaha we pay lump sum, the selling price plus the purchase selling price, which is the purchase price plus the profit. And for BBA, the payment is deferred. Okay, deferred, for example, for 20 years. So we take the selling price divided by 20 years. So if it is paid annually, but if it is paid monthly, then you have to divide that by 20 years multiplied by 12 months. So generally in Malaysia, murabaha is being used for short-term financing, and BBA is for long-term financing because it can be paid gradually. All right. So do you understand about this murabaha and BBA? So basically, it's actually a markup cost. So the cost probably 100,000. Then the financer will actually sell to you probably at 20% markup, so it become 120,000. So that is BBA. Now let's look at the next one, which is Bil Aina. So Bil Aina is actually involve two parties only instead of three parties. So the seller sell the asset to the buyer, whereas after that the buyer will resell the asset to the buyer at a higher price. Okay, for example here, now let's look at here. This is the financial, this is the customer. So the first step is actually that the customer, okay, will sell the asset to the financial, and then the financial will pay the purchase price to the customer, and then the customer will sell the price, okay, at a lowest. Normally it's a lower to the financial, and then the financial will actually the financial will sell the asset to the customer, and the customer will pay the selling price. Normally the selling price is actually lower than the what you call it, the purchase price. All right, so if you look at here, the repayment or to the financial can be done on installment basis or lump sum based on the agreement between both parties. Now, why do you think that this is happening? Okay, basically the bank, for example here, if you are a customer, you want to get financing, but you don't have, because you probably for your business or for your personal purposes, and then you don't have any money, so but you want to get finance. So what you do here, okay, the bank will sell, okay, the asset to the customer first. All right, so then probably at 10,000, and then afterward you, okay, will sell the asset to the financial bank at a lower price. So here first the bank sell at 10,000 on credit term, and then afterward the customer will sell to the financial on cash basis. So when you, for example, you purchase on 10 for 10,000, okay, you are now having what I call it, a debt of 10,000. Afterward, you sell back to the bank at 9,000, and then you will receive cash 9,000. So here you receive the cash, but you also in debt of 10,000. That's how they actually make money. There are actually two sale and purchase here. The first one is actually the financial selling to the customer, and then the customer sell back to the financial. So they get the difference, and then the cash they can use for whatever purposes. So this Bil Aina is actually is very, having a some issues with the from the Middle East scholars, because they don't actually say that Bil Aina is actually acceptable, because it's actually a backdoor to riba. However, the Bank of Negara of Malaysia has accepted the Bil Aina as one of the product that is being used in the Malaysian banking system and also the Islamic finance, because this is in the Mazhab Shafi'i, this is acceptable, but it must be not be the main product that we have to actually use. So it must be the last resort. So that's why that the Bank Negara of Malaysia and the Islamic scholars of Malaysia has accepted this. However, the Bank Negara of Malaysia has tried to actually shift from Bil Aina towards a different product, and now they are using Tawaruk. Okay, Tawaruk, which is involving three parties. Okay, three parties in the transaction. All right, now, okay, the next one, okay, the second type of product that is being used is the lease-based financing. So the lease-based financing we can look at into two. Okay, the first one is Jarah operating lease. Okay, basically it's actually the financial lessor agreed to rent the asset to the customer at a specific period. Okay, and then at the end of the period, okay, the customer need to return back the asset to the financial. So in this case, okay, the customer don't have to buy the asset. Okay, they don't have to put the asset in their balance sheet. They will just actually use it as an expense account. So basically, the rental will be deducted in their expenses. So it's easier for them to actually become less highly indebted to the banking. And the second one is al-ijara thumma al-bay, which is actually you rent first and then you buy. Okay, thumma al-bay. So afterwards you buy. So we call it ITAP. Okay, the financing lease. So basically the financial lessor agreed to rent the asset at the customer at a specific period, and at the end of the period, an option is given to customer. Either they want to buy the asset at a specific price, or just they want to return back the asset to the financial. So here you have an option whether you want to buy, okay, the asset that you have already leased, and if you want to buy it, then you have to pay a certain amount of money to the financial. Now let's look at the third one, which is based on the project financing, which is musyarakah mutanakisah. This is what I call it product which is being used by the many of the Middle Eastern banking system. So basically, it's actually comprises of partnership and also the sale and purchase. So basically, it's also comprised of another one which is leasing. So the diagram here explain how actually the musyarakah, which is partnership, mutanakisah is actually diminishing. So in other words, we can call it diminishing musyarakah. All right. First, the financial and the company will enter into a musyarakah contract. They will enter into a partnership contract to own a specific assets. Okay, for example, a house. Okay, and then this company and also the financial will actually contribute capital to the project. For example, probably the financial will provide 90% and then the company will provide 10%. All right. So, and then they invest in the project and then they'll get profit. So the profit flow will be actually go back to the company, some percentage. So let's say this is 10% and then this is X percent, which is 90%, and then rental payments and also share acquisition. So basically, the what I call it, the best part here is that, okay, remember last time the financial has 90% of share and then the company has 10%. The company can actually purchase or acquire the shares bit by bit, and at the end of the day, okay, the company can own all the shares from the financial and the company actually can acquire the asset. So that's why it is actually called diminishing, whereby the partnership, okay, the shares of this financial will be diminishing from time to time until at the end of the project investment. Okay, now let's look at mudharabah. Okay, mudharabah is actually similar to musyarakah because it refers to partnership. However, the difference is that the loss will be totally borne by financial, and because this is a bit different, because this is actually a concept that which has been used by the Prophet Muhammad SAW and also his wife Siti Khadijah during their business days. Okay, so basically the Siti Khadijah become the capital contributor, capital provider, and then the Prophet Muhammad become the entrepreneur. So the same concept is being applied here, mudharabah. So basically the company, which is the mudarib, amil, and also the financial is actually rabbul mal, as will enter into mudharabah contract, whereby the financial will contribute capital and also the what I call it, the amil will actually contribute entrepreneurship. Okay, entrepreneurship in terms of their effort and energy to manage the company. All right, and then they invest in the project, and then the project will be profit will be determined in terms of profit ratio. For example, 70% to the financial and also 30% to the mudarib or the company. So here, if there is some losses, then the financial will be will bond the losses and not the company, because the company has acted in good faith, has tried to do the best, their best to actually to get profit. However, that the business is not good, then they get losses. So basically, the losses is actually that they will face is actually the losses in terms of their effort. Right, they have done the best effort, but they still cannot make profit, so they have lost in terms of the losses of opportunity to gain profit. All right, so that is what we call it mudharabah. Then we have the trade financing letter of credit. Now the letter of credit is almost the same as the letter of credit in the conventional part. So basically, you will be having what I call it a series of what I call it procedures here. So you have the normally letter of credit is being used when you want to purchase a certain product or certain item from the domestic and also from international. So basically the applicant are normally are buyers, and also the beneficiaries are normally the sellers. So normally if you want to import product from the overseas, you need a letter of credit to guarantee that you the shipment or the purchase will be paid by you. So normally this is being used, okay, for importing from international, and also from domestic product. All right. So there are three type of contract under LC facilities, which is wakalah, and then the murabaha, and also musyarakah LC. So I will not explain in detail in much for the letter of credit, because it's a bit complicated to be explained in the video. I think I will have to provide a specific video just for the process of letter of credit. All right. So that is the what I call it, the four different type of um, what I call it, Islamic finance product that can be used in term of financing. So we have the murabaha and also buy bitamal ajil. We have the leasing, which is ijara and ijara al thumma buy. We have musyarakah, and we explain about musyarakah, mutanakisah, and also mudarabah. And also we have the last one is for the import and export for wakalah, LC, murabaha LC, and musyarakah letter of credit. So with that, I thank you. Assalamu alaikum warahmatullahi wabarakatuh. We'll see you on the next video, which is expanding business in chapter 18.